Hello there, folks. This is our lesson sort of to make up for the one we missed, or the one that didn't get recorded on option strategies, at least the part on option strategies where we were looking at collars and we were looking at spreads. So I just want to take you through the typical diagram here again. The first one that we want to look at is going to be a spread. And with our spread, what we're going to do is we're going to buy a call and buy a put. So we buy a call and we buy a put, and in doing so, we're going to create a bit of a payoff matrix here to benefit from stocks when they're showing a little bit more volatility. So with our spread, what we're going to do then is we're going to buy these at the exact same strike price. So this is going to be my strike price. I'm just going to use it as an example of $50. And think about through what our profit margin is going to be on both the call and the put that we buy. And let's go through the call first. So with the call, we know that anytime the price of the stock is below 50, that it's going to be out of the money. And in fact, it's going to be worth zero, but of course it'll be a bit of a negative profit because we've had to pay the call premium. So our profile looks like this. Once it hits 50, then our profit is going to increase. So the higher the stock price, the actual stock price goes relative to this strike price, then the higher our profit is on a call. It's a basic call diagram. With a put, of course, it works a little bit differently. And with our put diagram, again, it's the right to sell the stock at a certain price. So our, pardon me, I want to make sure I get the right color here. So with a put, it's the opposite. It's when the price is above zero that it's out of the money. So if we have the right to sell something for $50, but we could sell it for more out here, then we'd have a put that was not worth anything, and of course we've had to pay the premium. And so then the payout matrix for the put kind of looks like this. Well, what happens when we buy both of these? What happens when we buy both the call and the put? So I want to look really quickly over at what happens on this side over here. What's going to happen to our payoff matrix over here when we own both the call and the put? So here we go. So I've just deleted my diagram there, and we'll do this again here. So when the price of the stock is below $50, our exercise price, whatever, again, exercise, that's just as an example, our call our put is going to be in the money. So our put is going to be in the money. Our call, of course, is going to be out of the money. It's going to be out of the money by exactly this much. So we could almost think of that then in terms of both of them as being a drop down in price of what we would lose on the call. So when we sort of put these two together, then what we end up with is a payoff matrix that looks, or payoff diagram that looks like this. By the same token, when we think about the price So this was the price below 50. Price above our exercise price, what's going on? Well, we can think of our call option now. Of course, our call option has been worthless on this side. But once the price gets above 50, then our call option starts to be in the money. So our call option again, now it's in the money. So this is the call. But of course now the put portion would be out of the money. And it's out of the money by this much. So we do the same trick and we realize that if we're making money off of the call, it's that profit declines by the amount of the put again. And overall what we end up with is something like this. So we own the call, we own the put, and overall here's how it's going to look like. Overall what we get then is a profit where we're making positive profit as long as the price is below here, and positive profit as long as the price is above here. In between then, and we can see by this part of the V, that part of the V there, in between we're at a loss. So that's our spread. We're hoping that the volatility is such, and we would look for measures of really high volatility. We'd hope that it would show profit, it would be really high so we could profit here and profit here. The next one we're going to look at, low volatility, and it is referred to as a collar. So let's take a look at our diagram again here. So again we have our zero profit line, and we have our strike price. And we're going to sell a few options. So I want you to think about where our profit is when we sell a call. So when we sell a call, and I was going to do this in blue, as long as the price is below 50, we have the other side. Because we're receiving the premium, we make a profit. Once the price goes above 50, that means we're obliged, because we are writing the call, we are obliged to whoever we sell the call to sell them the stock for $50. Theoretically, we'd have to buy it from the market for more than $50. So we turn a negative profit here. Similarly, when we sell a put, so we're selling the right but not the obligation to buy the stock for $50, or we're selling the obligation to somebody else, right? Not the obligation to buy it or to sell it for $50. So we have the obligation, if they exercise it, to buy it for $50. So of course they're not going to sell it to us for $50 if the price is above 50. So we get to keep, again, we get to keep the premium. The minute that it goes below, though, then we have to buy it from them for $50, and the price we would get for it on the market is much lower. So when we do the same trick here, we just sort of say, okay, great, this would be right here would be my profit for just the call, or just the put, and the blue here is the profit for just the call. So when I put them together, I get a V that looks like this. And the same on this side. And get a V that looks like this. We just take what our call payoff would be and we increase it by the amount of the premium that we've received. So remember, we're the ones receiving the premiums. We're not paying the premiums. So in this case then, it's the exact opposite it was before. That V is inverted. And notice that once the price gets higher than here, we have a loss, but we also have a loss when the price is lower then here we have a loss. In between is where we make profit. So with this strategy, unlike the call, we'd be looking for low volatility. And those are your caller and your spread strategies.